Umang, welcome to
Hello.
F.A.C.E.
Hi there. Can you see me and hear me, Dale?
Yeah, I could see you. I could hear you.
Great stuff. Thank you very much. I've got a little presentation which I'll share with you in a minute if that's all right. But
Yeah,
first,
sure.
listen, I've been listening to you guys for about 3 years now, and I think it's fantastic what you guys all do. All the team, all of you guys. I feel like I know all of you because I listen to you every day and everything else. And it's really great macro color and very, very, very insightful and useful. And it's helped me a lot being in a very specific part of the market, which is the credit market. But
Oh,
just getting the
okay.
macro feel has been excellent. Thank you so much.
Oh, well, it's rewarding to hear. Our mission statements to build up and edify traders every day.
Yeah,
Let me just throw a little light on the situation. I'll be right with you.
Is he going to put 10p in the meter?
Let there be light. And there was.
Very good.
All right. So I went through your stream and I notice you have a lot of interest in physical fitness besides the markets. And you mainly retweet other people's stuff. Are you a trader? What do you do in the
Yeah.
credit markets, you
So, I
mean?
mean, Twitter has been more just it's a tool for interests and and learning about the markets. And I think some of there's a lot of nonsense on FinTwit. There's also some very good color. And I'm a portfolio. Well, I have been a portfolio manager for 15, 20 years, working in the credit markets. And the Twitter is useful as a research tool, I think, sometimes compared to the research we get from sell side, etc. It's a new view, and the way I've always traded credit, and I've been working for the last 10 years. I was based in Ireland as a head of credit for an Italian asset manager, and some of the macro color I get from you guys and everyone else has been very, very useful insight. And I've always traded credit with the very top-down macro feel to it. Of course, I go in and pick the instruments that I want to pick, etc. We'll go through that. Shall I just start my presentation and we can just
take sure.
If that's all right?
Yeah.
Let's have a look. See if I can find it. Yeah.
The share button there. You got it.
There we are.
Okay. Well, thanks for preparing something for us.
Oh no, it's pretty simplistic, but I just thought one of the things that we have with and I'm sure plenty of people that will listen to this, and some of you guys will be very developed and know about the credit markets. But often when I hear about credit, again on Twitter and in general wider senses, there's not a great understanding of how credit spreads operate and credit spreads work and the credit market operates. And people talk about H5G and LQD and say, look, credit's blown up, but there are really two components to a corporate bond. One, as we know, is the underlying interest rate curve, government bond curve, shall we say, and then there's the credit spread, the credit risk that sits above that, which is basically the risk for a particular issuer. And typically, a lot of people in the credit markets will trade credit, but will strip out the government bond risk or the interest rate risk and just trade that move in credit spreads. So I think sometimes we find that people say something's like, if you look at something like an LQD over the last year, the impact of the rates move has been so much more substantial than the credit moves at times. So I thought I'd just use this as an opportunity to talk about some of the moving factors within that. So if we go to the next page, very simply, that credit spread that sits above the bond curve is a function of two things: the probability of default and the loss given default. So par minus recovery. So what we're typically doing, and that spread essentially is basically derived by the market. So we almost often, the market buyers and sellers will derive what the spread is, but and then from that we calculate an implied default probability, and we make assumptions about recovery rate as well. So in the simplest example, if a recovery rate is 100%, theoretically the spread should be zero. Does that make sense? Just in sort of an idea of how we calculate that credit spread and how it operates and how it theoretically operates in the real world?
Yeah.
So that's that's what it is, but obviously becomes more complicated. And I know you guys and everyone talks about inverted yield curves when it comes to yield curves, and
where we're at
government bond
now,
curves.
because
exactly right.
that's where we are.
Mhm.
Okay.
Yeah. The interesting thing is when it comes to inverted yield curves, when you're thinking about it purely from a credit space, is we are then talking about the fact that the short-term implied probability of default on a company is significantly higher than if we go out in time, which says the company's got a very high chance of going bust, of defaulting. You know, if it can survive 2 years, if it can survive 1 year, it'll definitely survive. Well, much higher chance it'll survive 5, 10 years, etc. And typically, again, whereas this, inverted yield curves right now in the government bond world are function of what recession is. When it comes to credit curves, this is what it means. It means, we're talking actually about the default risk or the higher probability to default of a credit going bust. But most of the time, credit curves sit normalized. They'll sit with, the further out in time you go, the increased probability of default, normalized credit curve, etc. But there's just the basics. So, we live in this world where credit curves may be flat, they may be normalized most of the time. And in some cases, of course, as we get to a situation where a company is getting more closer to going bust or defaulting, inverted yield curves come into play. So this is the sort of simplistic example of what happens there. So this is what I really wanted to talk about, is how people make money in the credit universe. Is that something I can go into a little bit more? That's
Sure.
all right with you?
Yeah.
Yeah. So of course, the most, one of the main things with credit, and just like we talk about with companies, etc., in the stock markets, are the fundamentals, improving credit stories, downgrade possibilities, default risks, fallen angels, all these kind of things. But what I think is more, if you're an asset manager out there, or a credit portfolio manager, or whatever you are, whether you're buy and hold, whether you're an insurance company, whether you're Continental Real Money, most people look at things on a fundamental basis, pick the credits that they like, etc., and then they buy the instrument they want of that, and they sit on it. Some will be buy to hold, some will be mark to market. But how does someone consistently make money in the credit markets? Well, obviously fundamentals are very, very important. You need to know the credit stories that you're getting involved in, whether you're picking the winners and losers, but just knowing. But a lot of the time, credit spreads, and I've been trading investment grade credit most of the time that I've been in the market. If you've got an Apple or a BMW or a Microsoft, most of the time we're not talking about these companies going bust. They're not default risk, etc. But their credit spread does move around during the course of the year. Not yet. We haven't got there yet. But things change, right? There's a lot of names out there, and there are names that always are more risky than others. But a lot of investment grade credit doesn't really default. We've seen that. But they do move around. In the course of a year, credit spreads do move around. And I think a lot of participants miss this fact. And what caused them to move around? Well, technicals. And when I talk about technicals, I'm not talking about necessarily RSI and Fibonacci and things like that. In the credit world, it's slightly different. The technicals are simply a function of often flows. You've had Cem Carson on your show before, and he often talks about technicals and flows and how they apply to from the option market into the equity markets. But flows are such a big part of how credit spreads move in the course of a year. If you can look at things like the seasonality around supply, because a lot of corporate bonds are issued. There are seasons where companies have a lot more corporate bonds than they have, than they have one equity, universe of corporate bonds. Times of the year when rates sell off and insurance buyers come in and pick up credit spread, and that causes credit to compress. At the moment, we're in a phase where, even though I'm not in the market myself at the moment, we're in a phase where the search for yield has been so strong, because first time in 8-9 years we're seeing such a wider yield, etc., that people come in, they buy the bonds, and it's causing credit curves to actually become very, 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 very negative, almost very, very expensive, because the yield buyers are outweighing the spread buyers, or the guys who trade stuff on spread. And these kind of technicals and these kind of flows affect the market. Liquidity has a massive impact on it as well, because
let's stop there. So I'm sure in your journey You looked at the T-bond market here in the U.S. You lay off risk there. Liquidity has really dried up. It used to be the deepest market on the floor at the CBOT, and used to be able to get things done for the 30-second, the bid between the bid and offer.
That's right.
And now spreads have really blown out, and there's not as much liquidity in there. We did have a major credit event in the UK when we had to have central bank intervention to save the gilt market. And it looks like we're going to have gilt, pension problem 2.0 coming up, because rates are rising there again and look like they could go to new highs. So have you ever lived in an environment like this? Because, I can't remember the Fed on a course where they accomplished, or whatever you want to call it, raising rates that dramatically in such a short, compressed period of time, when people own paper in Europe with negative rates and the 10-year here at 2. Don't you think we're set up for a lot of solvency issues and the tightening of credit now after SVB? Isn't it kind of
Well,
hard to be a bull in the credit market?
yeah, I mean, what you guys talk about every day, and in general, the consensus is out there, is that that we've had such a huge move, such a quick and huge move in the rates moves, and we haven't really seen it felt. We've seen pockets of it. Like you said, you've talked about SVB, you've talked about what happened with the gilt crisis, etc. But they've kept on. They've been able to keep on going because these have been resolved one way or the other. Liquidity injections of various kinds have been put in. But have we really seen the impact of this? I can tell you just on the ground anecdotally that there doesn't seem to be a recession in the UK. I'm here in the UK. It doesn't feel to be. You go out and about and people are still spending money. Are people still, just from a real economy point of view rather than the markets? No, there's no sense of it as yet. And maybe there's a fallback. I know, in the UK in particular is an economy where, there are much more mortgages that are short dated, fixed rates, which people are moving into higher rates, and we haven't really seen it. I generally won't be surprised if we've just backloaded the problem, and it'll just keep on going until ultimately it does break in a much more angry way. And the markets, we know, are not the economy. And we talk about the markets, and I think what we've still got is this kind of just junkie mentality, because the yield, certainly in the credit space in Europe, I'm talking about the sterling market and the euro market, yields were so low for so long that the fact that we've suddenly had this explosion in yields has just meant fill your boots. The European, like I said, I'm out of the market at the moment.
It was electric shock therapy.
Yeah, exactly right. And it feeds, and even if people are just buying the short end of the curve, they're getting much more attractive yields right now than they've had. The same concept of me and you putting our money in an Apple 4.5% savings account. Well, if you're an investor, you're putting it into 1, 2, 3 year European corporate bonds at the moment, where you're getting 3, 4, 5% in quality names, which you were not getting. So the credit spread almost becomes irrelevant. It's the yield curve that's been so dramatically affected, and that money is just being put to work. And there is still so much money out there that needs a home. And we've had, the backdrop.
You want my address?
Very good. And we've had a backdrop.
Hey, move out. Umang's going to send people's money here. I need some room to stack it. I'll convert it to gold. Anyway, you have a view on, does a dollar come into the picture when you're analyzing credit, currency risk? Do you pay attention to currencies?
Yeah, I mean, obviously there's a cross-currency effect, and there are number one. There's this idea of portfolio managers out there and macro funds that can basically look between dollars and sterling, or euros, and you can buy maybe a BMW bond in euros or in sterling, etc., and dollars, and you look at the cross-currency. And it varies. Cross-currency spreads move around over time, and it has an impact. Yeah. And you'll typically find issuers the smart issuers in the US, for example, when the cross currency was in their favor, will issue into the Eurobond market, etc., when it suits them, etc. For me as a PM, my question was always, okay, fine. After cross currency, a bond might be significantly cheaper for me, a BMW bond or a Volkswagen bond in dollars than it is in euros. But what's going to cause it? What's going to cause it to perform? Because I'm almost like a trader in my seat. I'm trying to see what's going to cause that to the outperformance of it. I'm playing a relative value versus the other bond. I'm not looking at the yield and forgetting about it. So as a trader, you kind of look at it and go, what's going to make it perform? And I've generally found that with bonds that are issued into the dollar market, I never had the same picture or understanding of where those bonds were going to as opposed to what I can see in the euro market, where I can trade it much more and I can see the flow of it much more clearly. But yes, it does have it has an impact where issuers issue, and it impacts where people can buy them and trade them, I suppose.
Okay, so this chart you had before us, what's it telling you?
Yes, this is one chart, basically going back to the concept of what I was saying earlier on about flows and technicals and macro factors. A lot of times people talk about credit markets are ahead of equity markets. This is just a graph of European credit spreads versus the S&P 500 over the last few years. And typically what I found is the correlation is very, very high. Spreads obviously rally when the S&P rallies, the opposite way. But my point is, you've often talked about turnaround Tuesday. And let's think of a hypothetical example where we sell off on a Monday, equities sell off on a Monday, Europe opens on a Tuesday morning, the markets are weak. Market makers in the credit market seeing equities sell off, and they just keep marking their bonds wider, their credit spreads wider. And then Tuesday afternoon, regular trading hours, the S&P hits the support, bounces off it, starts to rally back, credit starts to tighten because market makers mark the book tighter. And my point is that credit often, equities go first and credit often follows. Certainly in the European market, I found in my history. And it's not always that well known. Credit spreads will often react. Okay, they've got their own technicals away from that. But I found that as a process that I've used is if you're able to have a good understanding of macro and a good understanding of what equities are doing and other risky assets are doing, that is a very good lead indicator if you're trading a credit portfolio. Which is again why I follow guys like you talking about the macro picture, because it's been so useful.
So if you can get the S&P right directionally, it gives you an edge when you're going into euro bond spreads.
Yeah,
how
correct.
to trade them.
Correct.
Okay, it'll tell you. So it's risk on, and it's not the bonds that lead. But you know what they did in the U.S. in last year? The bond market was even worse performer. Sovereigns, I'm talking now.
Yeah, sovereigns. This is the thing.
Then the market.
And I'd agree with sovereigns even in the European space. But the credit moves can often be linked to then what happens with risk on, risk off, right? They are essentially some of the same companies. And then it's a question of, but there are also second order effects. The fact that the yield curve inverted has an impact on buyers of credit risk, where they want to buy it, etc. So you've got to put all the pieces of the puzzle together, basically, when you're building a portfolio and things like that.
Okay.
And then it's about finding the best instrument. You can see this is just an example of bond versus CDS. These are credit spreads on a range of BMW bonds versus their CDS curve. And at the moment, cash spreads, credit spreads on cash bonds are significantly inside where the CDS curves are, etc. And of course, the CDS curve, CDS, as we know, is was designed as a hedging tool, but has become a speculative tool for many years now, as you know about from the GFC times, etc., and things like that. So, and then it's a question of once you've made a view on how you want to structure your portfolio, it's about picking the best instrument from where you want to be on the maturity spectrum, where you want to be in the cash, do you want to be in the derivative. From a technical point of view, from a flow point of view, market making point of view. We touched on it a little bit earlier on about market making and liquidity disappearing. Since the GFC, especially in the European market, we have had, the amount of warehousing that a market maker can have for corporate bonds has significantly shrunk. So as a result, you find we get these very gappy moves as well. And that ties in with the risk on, risk off that I talked about, where a bunch of dealers can be all be long the same bond. It can be marked wider, and suddenly you might get 3 or 4 buyers coming in when the S&P holds support, and all of a sudden dealers are all taking out their bonds, and we get major squeezes. And there just is the warehousing capability of the street is so reduced these days that it's a very gappy market.
Yeah.
You know?
So it's a fragile structure.
Yeah, it very much is so. Yeah.
All right. So, during these last minutes, why don't you give us a look forward as to the landscape you see here, or do you have a view, you have a narrative of where rates are headed from here, and can you forecast if you like the bond market, what part of it you'd be looking at? Would it be junk if you think we're going to be HYG? If you think, go ahead.
I think this year, even though we've, credit spreads have rallied, risk has rallied, it's felt relatively firm. It's not been the same ball game as we've had in the last 10 years, of course, because of, the underlying rates are significantly higher than they've been. And I think in a way, a lot of the junk spreads have not performed so well. People have basically parked in quality because they've been able to get the yield in quality. Does that trend change? I don't think so. I think and I think you've mentioned the S&P at 4,200, etc., which is a real line in the sand number, has been for a long time. It's the top of that range that we've been in. Should we break out of that?
Yeah.
Let's see what causes that. I personally think that when the Fed pauses, which I suspect might be in June, we might get this melt up that's been talked about, in certain circles for a while. You might see all risk rally. You might see a catch up. Bank spreads, for example, of course, since last month have underperformed a little bit. Could catch a rally, and subordinated spread could catch a rally. But it doesn't change my bigger picture that, a recession is coming. It's a question of when. There has to be a repricing of the amount of money that people are going to have disposable, etc., the real economy tightening with the markets. And we've been in a little phase. If I recall, and you might know this better than me, 2006, when the Fed paused, didn't risk rally for a few months before we actually started the recession talk, and then we started, it went from there. Like when the Fed typically pauses, or the central banks typically pause, is a phase where we see a bit of a risk-on rally. And then the reality, and when you start actually seeing the rate cuts, things change to the...
Yeah, I think it took a year after they paused for us to enter a bear market.
Yeah, so we could be facing something like that. Yeah. And I mean, European credit spreads, just purely credit spreads. And I know there's a dichotomy within that index, etc. But we're still significantly wider than we were at the tights. When the tights, basically, we sat at the tights all through 2021 and touched that level at various times over the previous 10 years. So there's a long way still to go to the tights. But again, the market is a lot more nervous. I mean, it's been the most hated rally. You could say the same thing in equities this year. It's been a hated rally. So they could carry on. I would not be surprised when the pause happens that we do get a short-term melt-up. And then we kind of, let's address the picture after that.
All right. Well, Umang, it was really a surprise. I didn't know what we'd be doing here today, but, I never would have known you were a bond trader from just reading your feed. And it's, to me, it's, you need people like that because I see all the complexity in your universe that you trade, and appreciate you coming here. Do you have a business model? Is there any reason you're on Twitter? Do you want followers? How can we help you out here at F.A.C.E?
Actually, I hope you don't mind me using this moment to market myself a little bit. So, Twitter, like I said, I follow you guys on Twitter. It's more of a recreational thing for me as well as picking up information. I'm not using it as necessarily a business model. But I was a credit PM for 9 years, working for a large asset manager as head of credit in Dublin. I was in Dublin, Ireland. I've recently moved back to the UK for personal reasons. My father got sick, and I wanted to be closer to home. And I want to take a little break. I took about 6 months off. I've traveled, and I'm now back. And I am actually looking for another role. I'm looking for, if anyone through your network of people who watch this who are, are looking to employ a credit portfolio manager in the real money or the fast money space, or want to talk to me about potentially raising assets to build something, I'm ready to go again. So I was just hoping, coming on here, presenting a little bit. I've got a very good track record with a Sharpe ratio of 3 over 9 years. So if anybody wants to speak to me or is looking to hire a PM, then I'd be happy to talk to them. You know, so I hope
Okay.
it's all right for me to ask that
No,
one
it's
here.
fine. And your Twitter handle again? It's
Yeah.
kind of unusual. What is it?
It's DUIN11. I think it is. I actually haven't even checked it. You know what? That is right. Yeah. It's
okay.
there
And
anyway.
you don't have a website, so that's really the place
Yeah.
for people to find you is Twitter.
Yeah.
Well, if I had a bond portfolio, I'd be talking to you.
Oh,
So
well,
you know,
really
I hope
appreciate
this.
that.
I hope that the seed that you planted turns into something. Let us know, and really a pleasure meeting you, Umang, and
Thank you.
glad our paths crossed.
Thank you, Dale. I really
Best.
appreciate it. And thank you very much for all the stuff you do for all of us that watch
All
you
right,
daily.
I'm rooting for you, buddy.
Thank you.
You're now my trading warrior brother, and I am rooting for you, Umang.
Thank you very much. Appreciate your time.
All right, buddy.
Thank you. Take care.
Umang,
Thank you.
You're very welcome. Guys, you could join the rest of the team in 15 minutes on the Morning Edge. Hope you enjoyed that. If you have interest in bond markets, or like, you know, I don't even know how many people watch us. I find out when I bring on guests that people watch us. So get a hold of the guy. Seems sincere. Can't hurt to talk. And what is this 420 stuff? Okay. What is 420? What's the meaning behind 420? Someone tell me before I check out here. Ingmar? Oh, it's Cannabis Day. Oh, no wonder I forgot what it meant. All right. All right, Scott. Yeah. Do a bong for me too, bro. All right, Mike. All you guys have a great day trading. Let's see if the S&Ps can hold that trend line. Don't just count your pips, count your blessings, everyone. Love you too, guys. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.